Hi, this is Dan Miller, Miller Financial Group. I'm recording this video here on Friday, the 14th of October. As everybody knows, we've had a lot of volatility in the market as of late, and I know it can be tough. And we understand that. We know that especially with the rising interest rate environment that we're in right now, with the Fed being jumped up, that there is a lot of volatility. And you pile on top of that all the disruptions that we're still dealing with energy and with a lot of the other pieces of our financial picture right now. I know, and a political picture, it can be pretty daunting. Today, I want to throw up on the screen here something that I think everybody should keep in mind, and that is if you are invested in the equities and bond market, that you need to realize that this is not a sprint. It is a long-term race. It is a marathon. As you'll see up here, what this chart represents is time, diversification, and the volatility of returns. Now, I first ought to say this is from the JP Morgan Guide to the Markets that came out here in September of 2022. This is from page 63. The source is from Bloomberg FactSet. The stock portfolio that's represented here is the S&P 500. And the S&P 500 Shiller Corporate Bond Index is what represents the bonds here. So, and again, I should point out, of course, that future results will not mirror past results. So we can't predict the future based upon the past. But I do want to show some of the things that have happened. If you look at annual total returns from 1950 to 2021, so 71 years of history. So to keep in mind, we are looking at a long-term scenario. So if you look at the chart there and you look at the first over on the left-hand side, you'll see the green bar, the blue bar, and the brown or the grayish bar. The green bar represents if you take all 71 years of rolling 1 year periods. In other words, that would be starting on January 1. That would be starting on January 2nd. You look at all those 71 year rolling 1 year periods, a 1 year return in stocks. If you were trying to pick that right year to own stocks, you might make 47% based on the S&P 500 that year, or you might lose as much as 39% in that 1 year if you were only investing for 1 year. Okay. The blue bar represents the same thing with that bond portfolio that's represented by the Shiller index that we referred to. You might pick a year that your bonds made as high as 43%, but they lost as much as 8%. Okay, so, and then you look at the tan or the brownish grayish bar. A 50-50 portfolio could range everywhere from a high of 33% to a low of 15% in any 1 year. Now, if you just scroll that out and look at all the 5 year holding periods, okay, so now you're holding it for 5 years. You can see, like with a pure stock index, the worst 5 year rolling return was a -3. The worst bond return was a -2. And the worst 50-50 portfolio return on a diversified portfolio was a +1. So time in the market made a huge difference. So you go out to a 10-year rolling period. In other words, you look at all the 10-year periods that have happened from 1950 to 2021. If you had a pure stock portfolio based on that S&P 500, the worst it would have done is a -1 anytime that you held for at least 10 years. The worst that a bond portfolio would have done would have been made 1%. And the worst that a composite portfolio did was made 2. So then if you have a 20-year time horizon that you're aiming for, you can see when you look at every one of the 20-year holding periods, that the worst stock portfolio during that 20-year holding period, anytime in that 71-year period, the worst it did was made 6. And the worst bond portfolio that it did, if you held it for 20 years, was made 1. And the worst composite portfolio, blended portfolio, 50-50, made 5%. And you can see also up above there, over that total period of time, from 1950 to 2021, you can see what the average stock, bonds, and 50-50 portfolio returns have been. So again, I wanted to put this up here to kind of keep things in perspective. I know we're going through some really tough times right now, but if you are in the equity markets, you shouldn't be investing for 1 year periods. You should be in it for the long term. All right. So again, if you have any questions, please feel free to reach out to myself, Caleb, Marcus, anybody at Miller Financial Group. We'd be happy to visit with you about your portfolio, about your time horizon. Is there adjustments that need to be made? Again, I understand that we're going through a tough period right now, but as you can see, based on history, again, we can't predict the future based on the past, but based on history, again, trying to time the market and jump in and out has not been as effective as being able to be in the market for long periods of time. If you have any questions, please reach out to us. Thank you, Dan Miller, Miller Financial Group.